next guest says if these tariffs do continue, we could see a global recession in the next 9 months. Chetan Ahya, chief economist and global head of economics at Morgan Stanley, joins us now. So your call got a lot of attention. Chetan, tell us exactly what you mean in terms of tariffs and the economic forecast.
So what we're saying is that if tariffs go up further to 25% on the balance 300 billion of imports from China and stay there for 4 to 6 months' time, and China does take countermeasures somewhat similar to what we have seen overnight, then we will see global economy entering into recession in 3 quarters' time, i.e. 9 months' time. And essentially the most important transmission mechanism that we are conscious about is what happens to corporate confidence. Now, when you look at the global PMIs right now, the new orders component, which we think is the leading value, is already down to 7-year low. And these additional rounds of escalation will take that corporate confidence down further. We are also conscious that at some point of time, this will become non-linear, i.e. that corporates will really give up and start doing job cuts. At the same time, the financial markets could behave non-linearly. So that's what is the basis for a call for recession.
What happens if tariffs only go up by 10%, not 25%?
So if tariffs go up by 10%, then in our base case, we think it will become 2.8% global growth, which is pretty close to the 2.5%, which is the recession threshold. And mind you, this is coming down from 4% in first quarter last year. So we would have seen a full 120 basis point decline in global growth because of trade tensions from second quarter of 2018.
So in this scenario of a global recession, Chetan, does the U.S. still look like the best house in the neighborhood and U.S. stock market the best bet?
Well, no, actually, in this last round of escalation, we think actually the U.S. will probably see a lot more pain compared to the rest of the world. The rest of the world had actually been slowing from second quarter of last year, but the U.S. was positioned in a much better position because of the fiscal stimulus tailwind. And we are seeing that in the last 4 or 5 months, the U.S. is actually seeing a lot more downside. So if you look at, for example, PMI indices, you plot that for rest of the world versus U.S., the U.S. is very quickly joining the rest of the world and underperforming. And so from a growth perspective as well, we think that the U.S. is where there will be probably more downside. And the way that downside comes in through is the U.S. capex. I know that everybody talks about the fact that the trade and manufacturing in the U.S. is a smaller proportion of GDP, but the capex numbers are for the overall economy, and those are declining very significantly. In the second quarter, as you know, U.S. corporate capex declined by 0.6%. And in the way the global economy is going, our view is that the U.S. capex will decline further. It will impact the job market and therefore retail consumption. And so the U.S. will actually see bigger downside at the margin now.